4 times a year, trillions of dollars in options and future contracts all expire on the same Friday. Stock options, index options, index futures, all of them. Same day, same deadline, and Wall Street calls it quadruple witching. And every single time it happens, the same thing plays out. The problem? It's not random chaos, there's a pattern. And the pattern has a name. So let me show you exactly how it works and why it might explain that random red day you saw in your portfolio and you couldn't really figure out. Another reason, fucking hate this market. And if you're new here, I'm Nate. I've been around this market for years. I dig into the moves people at the top are making, so you have to read the fine print yourself. So here's what actually happens. 4 Fridays a year, the third Friday of March, June, September, and December, every major derivatives contract in the market expires at the same time. Stock options on companies like, Apple, Tesla, say Nvidia, index futures on the S&P 500 and NASDAQ, options on those index futures, all of it. In March of this year, over $5.7 trillion in notional options exposure expired in a single session, and that was the largest March expiration Citigroup had on record going back to 1996. The S&P 500 saw the single highest trading day volume of the entire year. Not on an earnings day, not on a Fed day, on witching day. So here's where you come in. There's a concept called max pain. It's the strike price where the most options contracts, both calls and puts, expire completely worthless, the price where option buyers lose the most money and option sellers, mostly market makers, keep the most premium. And as expiration gets closer, market makers hedge their positions by buying and selling the underlying stocks. That hedging creates a gravitational pull toward whatever price makes the most options expire at zero. Traders call it pinning. So the stock you're holding doesn't move based on the company's, fundamentals that day. It moves based on where the largest pile of expiring contracts sits. Market makers, they're not trying to make you money. They're trying to make your options expire worthless, so they keep the premium that you already paid them. Here's the part that should keep you up at night. In December, Goldman Sachs put the number at $7.1 trillion in notional exposure expiring in one session. It's like 10% of, the entire Russell 3000's market cap in one afternoon. The volume spikes, 50 to 100% above normal, spreads widen by 20 to 30%, and the most of the damage happens in the last hour of trading between 3 and 4 p.m. Eastern. Well, that's what they call witching hour. That's when institutions dump, roll, and rebalance all at once. And if you're holding an S&P 500 fund, or you've got a 401k, or if you own shares of any large cap stock with heavy options activity, you felt it. You just didn't really know what it was. So what do? Well, mark the dates on your calendar. It's the third Friday of March, June, September, and December. You don't have to panic sell. You don't have to chase a random dip, but you stop assuming that every red day is about the company and that you're just flourishing and flocking to the news headlines. Sometimes it's about the plumbing underneath the market. The options, expiration calendar is public. The open interest data is public. The max pain levels are public. The information is sitting right there. You just have to know it exists. So follow for more and hate this market with me.